Hello, my name is Przemysław Kwiecień, I'm Chief Economist of the XTB, and it's my pleasure to be with you today to discuss markets at the beginning of the next exciting week in January. So today we're going to discuss inflation a little bit more because last week there were some, you'd say, market turbulences, and at least partly they were related with inflation. However, inflation is obviously much more important than what we had last week, and we discuss why and whether higher inflation should be a concern for us today. So that's going to be the main issue that we will discuss today. However, let's start with the top news as we normally do on Monday morning, so it's all you need to know on Monday. And the first point is kind of a profit taking that we are looking at right now on most of the markets, certainly on indices. I would say this is just profit taking. I wouldn't even call it correction, because when you look at where the markets are, like US 500, like US 100 or the 30, compared to where they were even a year ago, where we were at before the pandemic, these levels are still extremely high. So these small declines that we had at the end of last week, I would say it's still something minor, but it's been caused by two factors. First of all, it's been caused by a delivery of Biden's package, something that markets were positioned for quite a while. So whenever along the saying buy the rumor, sell the fact, I think that was one of the reasons for the profit taking. The other was, like I said, higher inflation expectations. On Friday we had University of Michigan survey released, and it showed 1 year inflation expectations at 3%. So this is something that the market is paying attention right now, and it caused stronger dollar and somewhat lower gold and silver prices. We'll discuss all of these markets in the second part of today's presentation. Today in the morning we had data from China, and data which was pretty solid, with higher output and weaker sales and higher GDP to end 2020. I think the data what we had together with what we had last year, I think it shows China is clearly winning on the global stage, even though obviously China itself, they had to pay for the pandemic in terms of lower output for some months, but they recovered quicker than the US, quicker than the other countries. And right now, as you can see, higher output, weaker sales. What it means is that they do not need to prop up their internal demand, because they are taking advantage of all these stimulus being applied in US and Western Europe, and they had two record months in terms of trade surplus. So China is clearly winning from the pandemic, and the data continues to show that. This week, in terms of calendar, we have a bit of specific week, because we start with holiday in the US, Martin Luther King holiday, but then the calendar will get more intensive as the week progresses, and we have ZEF index in Germany on Tuesday, Bank of Canada, and more importantly Biden's inauguration on Wednesday, and then very intensive Thursday with Bank of Japan, Bank of Turkey, and most notably ECB, and some US data, and then flash PMIs for January on Friday. So the second part of the week, I would say, is going to be quite interesting. So let's turn to the topic of the week, and that's inflation. Will inflation return? First of all, let's start a quick analysis on why is this important. Here in this table, you can see a simulation on terminal value of a stock. It's hypothetical stock, so do not pay attention to a specific number, but what I wanted to say is relationship with 10-year interest rates, because as you can see, when you compare this hypothetical simulation from present to what we had in August, this last line is quite similar. It's slightly lower, but it's quite similar, and it's a reason of higher bond yield, which is right now above 1%, and it was about 50 basis points in August. That was 2020 low. However, because of all the vaccines, we have higher expectations regarding growth. So you could say these factors work in opposite direction and they somewhat compensate each other. However, imagine right now that with all the factors being constant, you have 10-year bond yield rising to 3%. Suddenly, as you can see, value of the stock would drop to as low as 2500, so nearly 50% down from the present level. So as you can see, higher inflation causing higher market yields, bond yields, and other interest rates would be very detrimental for the market, would be very detrimental for equities, because quite simply everything that has underpinned the rally would not be relevant anymore. People would have alternative, would be able to buy bonds, would be able to deposit money, and all these discount rates would suddenly bite into model valuations. So I think this shows pretty clearly why inflation is very important, continues to be a very important factor for the markets. And the reason that so many people discuss inflation these days is that we can see it around. We can see prices of oil, we can see prices of food going higher. We hear a lot about central banks printing money, so we think, okay, there is more money printing, we see higher inflation around of us, so there need to be inflation, and what's the next step? However, I would like to caution you that inflation is not always equal. Here you can see on this chart why it's the case. You can see 4 key measures of inflation in the US, and right now all of them are low. It's the red arrow shows where we are right now. However, as you can see with the simulation that I did for you, if we assume that prices keep rising as they did between 2009 2011, so 3 years after the previous crisis, you'd see CPI inflation, the most popular one. It's the case especially in Europe, in UK. CPI is the most popular inflation, and actually it's most of what we feel when we go to a store, when we go to the gas station. This is what we feel, and this is at least should be expressed in the CPI inflation. And as you can see, if the history repeated itself in the US, this inflation would rise quite quickly above 3% and then stabilize around 2.5%. So you would say, okay, that's what the Fed wants. They want inflation above 2%, and that's the reason they should already be thinking about increasing interest rate. But the Fed says, no, we are not looking at CPI. We don't care about CPI. We care about PCE core. And as you can see, with the same assumptions, this inflation stabilizes on 1.5 percentage points. So this is a quite big difference between them. So the most likely scenario going forward is that there will be inflation biting into disposable incomes, but the Fed will say there is no inflation. So how, as ironic as it sounds, this is the most likely scenario. Why is that the case? Well, first of all, there are quite big differences between measures, and you can see them in that table. But what we need to pay attention to is that this Fed inflation doesn't include food, doesn't include gasoline, because this is quite reasonable. You can say, okay, the level of interest rates doesn't have much in common with how much oil is being produced by OPEC. So that's one of the arguments why not to look at this headline inflation, but rather focus on the core inflation. However, at the same time, the core inflation, all the measures for the matter, but especially core, they have higher percentages of quite strange categories. 2 of them I highlighted with yellow. This is the most important is owner's equivalent rent, where you estimate how much you would spend on renting apartment or renting a house, even if it's your own one. So you could say it's quite ironic that the Fed doesn't look at the food or the gasoline, but they look at some artificial category which actually is not being spent, because as you can see, rents, actual rents, it's only 4% in the PC, whereas this owners equivalent artificial category is 16 percentage points, so it's quite significant. Then there's recreation, and there is another catch, that when we think about inflation, we think that it's always price increases. However, when the world we live in changes constantly. So what we have today, especially in electronics, in computers, in smartphones, is completely different to what we had 10 years ago, 20 years ago. So the clerks, what they are doing, they are looking at how these things change, and if they think something improved, they actually change the relative price, kind of. So I gave you an example to illustrate it. Let's say the new gaming console is 10% more expensive than the previous one. We have right now new consoles, series of new consoles, but a clerk decides that it's also 20% better. So in inflation, you would have price 10% lower, even though you pay 10% higher. And the ironic thing about it is that, as you can see here, in the US, the category of these goods is deflationary at a rate about 10% per annum for the past 20 years. So obviously you'd say it doesn't make sense, but that's the reality. So to sum it up, the most likely scenario is that we'll have inflation and it will bite into disposable incomes, but the Fed will say there is no inflation because they look at different measure. So how, as outrageous as it might sound, that's most likely to happen. However, there is still some probability, I think it's lower than 50%, but it's some, that this inflation will push the Fed out of this extremely expensive monetary policy. What would need to happen is that we have some service sector inflation caused by the pandemic, actually, because some of the companies are out of the business. So when the demand is back, there will be less of supply and they will have more pricing power. But also you need to have rising rents in the US. These two effects need to happen in order to push this PCE core inflation into the category, into the territory that will be uncomfortable for the Fed. I think this is still a relatively unlikely scenario. However, markets do not pay nearly all the attention, and there is assumption that low interest rates are here to stay for a long time. So even though this scenario is quite unlikely, you need to be aware and you need to be prepared, because when inflation rises, then if it rises, then the repercussions will be quite brutal, because everything assumes right now that interest rates will stay extremely low or negative nearly forever. So you need to be on alert, and you certainly need to track and prepare your portfolio in case this happens. All right, so let's move on to the market summary at the beginning of 2021. Let's start with indices, which were really in a good place until Friday. Mostly taking advantage of these speculations towards the Biden's package and the assumption that additional payments to households will be spent on stocks. So basically, as ironic as it sounds, that was the key driver for the markets right now. However, looking at many factors, option markets, something we discussed in December, number of IPOs, number of hot stocks, all of these measures seem to suggest that we are in the late stage of the bubble, and this means that we need to be prepared, and we should prepare our portfolios for many scenarios, because on one hand it's nearly impossible to say, even if it's right that this is a bubble and it will burst at some point, it's nearly impossible to get the timing right. The thing with the late stages of very hot market is that it can be short-lived, but the price dynamics could be so brutal that if you bet against it too early, you could be right at the end of the day, but you could be out of the capital before it happens. So certainly this is not yet the market that you can be certain that, well, it's the end. Certainly not. Like I said, this inflation scenario is still quite unlikely, and there will be more stimulus in the US, and quite likely some of it will find its way to the stock market. So the timing will be very tricky. However, as you can see on this chart, there are many measures warning us, look, it's overheated. And you can see once again we have the put call ratio at the record low right now, the volumes at the record high or close to it. So at least it suggests we should be hedging some of our equity portfolio to prepare for adverse scenario of deeper market pullback. And I gave you an example of how to do it using the CFDs. And here you can, for instance, with US 500 at 3,800, one lot is worth 190k. So with if you had a portfolio of $20,000 of US stocks, you'd need 500s of a lot on the short side to hedge 50% of your portfolio, right? So this way you don't need the hassle of buying, selling of the stocks, but you can stick with your portfolio and hedge it with the CFD contract to make sure that whenever deeper correction occurs, you have at least part of your portfolio hedged. Going forward, quite interesting developments on the FX part of the market with these inflation rumors, because as you can see, we have US dollar index very close to the lows from the beginning of 2018. And while in the long run, it's still expensive US dollar, you can see that back in the 2008, 2011, US dollar was much lower. But at the same time, US dollar is very oversold, most oversold on the CFTC positioning since 2011. And that means that with this inflation chatters, you can have at least a deeper pullback. And the same story, of course, applies to euro dollar, which is the biggest component of the US dollar index. And you also can see here rising bond yields in the US, whereas the German yields are flat at deeply negative levels. So the spread again reverses, and it kind of suggests that the rally is unlikely to continue for a long time. So from that perspective, the market is changing in favor of the US dollar, and this level of positioning suggests that there could be some at least correction in the weakness of the US currency. That has repercussions for gold and silver, because these markets used a combination of very loose monetary policy and weak US dollar. And as you can see here, 2020 was very good for them, and a lot of money found its way to ETFs for them. But right now we see some stabilization here, and both stronger US dollar and both stronger US dollar and higher bond yields are negative for these markets. So as bullish as I was for these markets for a long time, right now I'll be more cautious, and I would look for these markets to panic a little bit before getting back there, and before re-engaging a bit more aggressively. As you can see, gold and silver looks maybe a little bit more bullish than gold on the chart, but in both instances you can easily say that the trend is no longer positive, at least for a moment. And like I said, a really long-term outlook is still favorable, but I would love to see some stronger US dollar. As I said, this correction is possible. The bond yields are on the rise for now, and if there is a small panic and yields shoot up for a moment, I'm sure the Fed would at least try to contain them, but before they do, that could drive gold and silver lower temporarily, and that would be the opportunity that we'll be looking for from a fundamental perspective. Oil market, it's been rallying quite hard at the beginning of this year, and when we compare the situation to 2009 and 2016, we can see that it's quite possible that this is just the beginning of a bigger rally. The OPEC is trying to protect the deficit to keep prices rising. However, like with everything, recently the markets is quite hot, as you can see. How strong we move from October. It's really exposed right now. So at least a correction, maybe towards 50 for Brent, is something that would be sound on this market right now. And finally, Bitcoin. It's been very dynamic recently, but just keep in mind two things. First of all, usage of Bitcoin in real economy actually declined for the past 3 years. So from that point of view, there is really no strong argument for this market to keep advancing. And while Bitcoin is certainly taking advantage of fears of destroying the paper fiat currencies by central banks, and I agree this is a valid argument, but from that point of view, you could argue that Bitcoin is in some kind of competition with gold. And as you can see right now, the price of Bitcoin in gold is also at record levels. So I would rather lean towards conclusion that we are in a similar position that we were at the end of 2017. I will need to see a deep pullback in order to for Bitcoin to be any attractive again. Alright, ladies and gentlemen, it was my pleasure to be with you this morning. Please stay with us. You can track news section in Xstation and Xstation mobile platforms, where we try to provide you market coverage from Monday to Friday. We try to analyze all the data of the markets, give you some technical analysis. So stay with us, and we see each other next Monday again. Have a good week. Bye.